So this is part 5 or part 6. I don't remember which part this is. Maybe part 6 of this multi-part video series in which we are discussing positional trading on weekly charts. Now, by default, positional trading means we are only looking at stocks which are fundamentally strong. So in this video, we will discuss the fundamental criteria to look at to determine whether that stock is fundamentally strong or not, or whether that stock is worth considering for a positional trade. Okay. So if you read William O'Neill's book, see, this is the source of this little presentation is How to Make Money in Stocks by William O'Neill. All of what I am going to discuss in this video is already available in the public domain. It is already there in the book. This is just a quick summary of what to look for to precisely determine whether the stock is fundamentally strong or not. And this is exactly what I teach in my video course as well. There is nothing different. 99% of what I teach, okay, or whether it is on YouTube or whether it is in my video course, 99% of what I teach is something that I have learned from William O'Neill and Mark Minervini and David Ryan and Patrick Walker. Okay, those are the four guys. I have looked at their interviews, I have read their books, I have done a lot of research myself. And based on that, I have created my own system that helps me determine which stocks that I should get into. So all of this criteria that I'm going to discuss is already available in the book. This video is like a shortcut where you quickly get to know what to look for. Okay. In this video, I will share with you the importance of all of this criteria. Okay. In the next part, this is a multi-part video series. Okay. In the next part, we will look at how to apply this criteria, what conditions to look for that should help you definitively say, okay, this stock is fundamentally weak, this stock is fundamentally strong, this stock is fundamentally very strong. Okay. So the first criteria, see EPS, there are 7 different criteria. So you understand how important EPS is when it comes to William O'Neill's breakout trading system. The reason why I keep mentioning William O'Neill is because this entire positional trading multi-part video series I'm able to do only because of what I learned from William O'Neill. Okay, so complete gratitude to my mentor. He passed away not long ago, but legendary person. Coming to the criteria, the latest quarter EPS growth should be more than or equal to 40%. So William O'Neill and Mark Minervini, people like them, did a study of all the leading stocks of the past 100 years, even more than 100 years. They looked at stocks dating back to late 1800s. They studied all the leading stocks of the past and they found out that on average, the latest quarter EPS growth of leading stocks before they began their big full-scale price advance was in the range of 40% to 500%. The more, the better. Okay. That's why the minimum criteria we look for is latest quarter EPS growth is greater than or equal to 40%. Quarter doesn't mean quarter on quarter. So if I'm looking at December 2024 number, EPS number, I will compare that with December 2023 EPS number and then calculate the percentage gain. Okay. That should be 40%. However, in the book, it is also mentioned that a majority of leading stocks, the minimum that they had, this was average, okay, the minimum that they had was 18% latest quarter EPS growth. So you must have noticed in the filter when I put the EPS growth rate criteria, I put 18%, not 40%. Okay, because of the next criteria. This is 3/4 of EPS growth acceleration. So let's say latest quarter is 45%. The quarter before that is 35%, and the quarter before that is 25%. So 25, 35, 45. So this is called 3/4 of EPS growth acceleration. That acceleration is important. But what if this is not 40%? Let's say this is 25%. Then at least we need to check whether 3/4 of EPS growth acceleration is there or not. So let's say this is 25% latest quarter. The quarter before that could be 18%, and the quarter before that could be 10%. So 10, 18, 25. That is acceptable, right? One of the criteria is not met, but at least the next criteria is met. Okay, so something is in our favor, correct? Next, the annual EPS growth rate should be more than or equal to 25%. So this was quarterly, this is annually, more than or equal to 25%. And I will show you in the next video where to look for exactly these numbers on the MarketSmith website. Okay, you don't need to look at multiple websites to calculate these numbers or observe these numbers. We need one website where we can check everything so that our system is simple. Our system of analyzing stocks is simple. EPS annual growth rate 25%. Why is this important? Well, if you look at what David Ryan says that on average, if the growth rate of a company annual is 25% for the past 3 to 5 years, that's generally a stock that has a very high probability of giving a good gain. This was observed when leading stocks of the past were studied. So this is something I picked up from David Ryan, but it's also given in William O'Neill's book. Okay, but the importance of it is something that I understood from David Ryan. Okay, EPS stability, it should be less than or equal to 25. Okay, I will share with you how to check for this number. This basically determines whether the stock has stable earnings growth or not. Some stocks might show 100% growth in one quarter. Next quarter, it could be 12% growth. That's not stability. We want a stable EPS growth company. Okay, so that number should be less than or equal to 25. They calculate stability. This is MarketSmith's proprietary calculation. Okay, we'll not get into that. There is a video on my YouTube channel where I talk about EPS stability and how they calculate that number. It's a bit complex, but don't get into that. Just focus on the number itself. Okay, as long as it is less than or equal to 25, we are fine. See, when we put food in the refrigerator, we don't ask how the refrigerator is working or what compressor is there inside or how does it function. When I'm driving a car, I'm not bothered what engine there is or how does it function, the whole system. I just know how to drive a car. So similarly, take it like this: EPS stability less than or equal to 25. So they know MarketSmith has already done this. MarketSmith is more than 50-year-old company, debt-free company, privately held company. Nobody has ever bought them. Okay, so they know what they are talking about. So let us stick to EPS stability number less than or equal to 25. So they are not giving us their opinion. They are giving us the fact. This is a fact. This is not an opinion. Okay. 3 years of positive annual EPS growth. Now, please try to understand this. Is very important. So the growth rate here is not important. Growth rate is coming here. This is compounded annual growth rate. Okay, not point to point or year to year growth rate. Here it says 3 years of positive annual EPS growth. So even if the growth rate here is 1%, that is fine. So for example, let's say in latest year, the EPS is 35 rupees. Then the year before that, the EPS is 32 rupees. And the year before that, the EPS is 31 rupees. So it's 31, 32, 35. It's almost the same, right? But you see, it is growing. It went from 31 rupees to 32 rupees to 35 rupees. The percentages might be very small, right? Less than 25%, but at least it is showing positive annual EPS growth rate. Sorry, growth, right? Now imagine if the latest quarter latest annual EPS is 35 rupees. The year before that is 32 rupees. But the year before that is 50 rupees. So it goes from 50 rupees to 32 rupees to 35 rupees. Not acceptable. Okay, because it went from 50 to 32. That is decline. It's not positive annual EPS growth. Not allowed. Okay. Not allowed does not mean that you reject the stock. Not allowed simply means that there is additional risk in the stock. So you have to go in with a low position size. Something like that. Okay. Don't reject stocks because this criteria is not met. Okay. If this criteria is not met, it simply means that there is more risk in the stock, and risk can be controlled with stop loss and position size. Correct? So please understand what I'm saying here. You can't use this criteria rigidly. You have to look at this criteria for each stock and determine how many are in our favor. Okay. The more they are in our favor, the better it is, the lesser the risk. Annual EPS at an all-time high. So let's say the latest annual EPS is 35 rupees. And if you look at previous years, it has never touched 35 rupees. That's a very good sign. The annual EPS is reached at an all-time high. Then quarterly EPS should be more than annual EPS. Obviously, if the annual EPS, it's not EPS, it's EPS growth. Okay, here it is EPS. Here it is EPS growth rate percentage. Okay, so I should make that correction here. So let's say the annual growth rate is 55% and quarterly EPS growth rate is 25%, which means what? Well, the growth rate has declined. Annually, it was growing at 50%, 55%, and now suddenly quarterly it is showing 25%. So there is a problem with the company. That is why the quarterly EPS growth rate latest quarter should be higher than the annual EPS growth rate. This number, okay, this smooths out the return. So this is 7 criteria. Okay, there are total 12 criteria that we will discuss. All of this, by the way, is given in the book. I have mentioned the source here. If you want more details, you can study that, but this video should be more than sufficient. So the purpose of this video is to help you understand the importance of each of these criteria. The purpose of next video of part 7 would be to help you understand how to check this criteria on MarketSmith and then determine whether the stock is worth considering for a positional trade. Correct? So out of 12 criteria, 7 are based on EPS. So you understand the importance of EPS, right? Earnings per share. The remaining 5 are not that important because the most critical determinant of stock price increase is EPS growth rate, which you understand from what we have discussed here. Next is sales. Sales. Okay, latest quarter sales growth should be more than or equal to 25%. It's given in William O'Neill's book. 3 quarters of sales growth acceleration. So let's say the latest quarter sales growth is 35. Quarter before that is 25. Quarter before that is 15. So 15, 25, 35. That is called as acceleration. Now you must have noticed in the filters, I did not put 25% latest quarter. I put 10%. Why 10%? Because we need at least a double-digit return, double-digit growth in sales. That is my input to this whole criteria. So I want at least a double-digit growth company in terms of sales. See, if the sales of the company is not even growing at 10%, why should I even bother looking at the stock? There's something wrong, right? If the company wants to make money, first it has to make sales. Okay. So I need a company which is at least showing double-digit sales growth. This is not William O'Neill's criteria. This is my criteria. So I put minimum 10%. Then I check this. Maybe latest quarter is 10%. Quarter before that is 8%. Quarter before that is 7%. So 7, 8, 10. That is still allowed, right? Of course, the risk is high because it's a slow growth company, but still at least one of the criteria is in our favor. Correct? So what we are trying to do here is we are trying to stack the odds in our favor. You would find companies where out of 12, 9 or 10 criteria are in your favor. Well, that's a stock we should be buying. It's very simple, right? But you might find stocks where out of 12, only 6 criteria are met. Well, in that case, you go in with a small position size, maybe half position size, half of whatever your normal is. For some people, normal position size could be 6.25. For some people, it could be 10%. For some people, it could be 20%. I don't know. But you could go in with half of your normal position size. Okay. So 7 criteria for EPS growth, 2 criteria for sales growth. Okay. Sorry, not EPS growth, EPS. This is for sales. So 7 plus 2 is 9. We have 3 more left. Then you see return on equity. This you already know. I have discussed this multiple times. Should be more than or equal to 17%. By the way, this is not an opinion, this 17%. Where does this number come from? Well, when William O'Neill looked at 100 years of stock price data, and looked at all the factors that contributed to the strong share price increase, he found out that almost all of them had a return on equity of at least 17%. So this is not an opinion. This is a fact. Okay. And we are using fact. This is called looking at precedents, precedents. Okay. Precedents. Looking at history to determine what is the optimum return on equity level which propels a stock price up. That's where the number is coming from. Okay. So we are not creating a strategy and then trying to backtest the strategy. No, this is not about backtesting. This is about studying the previous leaders and trying to find out what characteristics they were displaying before they began their big price advance. And this is what he found out. Okay. That is why I like this William O'Neill system better. Okay. Because it is about, this is not about backtesting. This is about studying the history and then determining what leads to success of stocks. It's very simple to determining what makes a person successful. What makes a person successful, right? Good education, good communication skills, good behavior with people, good networking skills, good business skills. These are the things that make a person successful. And these are the skills that can be acquired over a lifetime, right? Similarly, for stocks, there are certain characteristics that make them successful in the stock market in terms of price movement. That those are the characteristics that were spotted by William O'Neill. And this was done in the 60s, right? So ROE greater than or equal to 17%. Now, if ROE is not greater than or equal to 17%, then you look at margin. Okay. Net margin should be expanding for 3, 5, or latest 10 years. So net margin means after tax margin. Margin is the amount of money that is left over after deducting all the expenses of the company from the revenue for that particular year, including taxes. That's the margin. What is the net amount that comes in the hands of shareholders, right? I'm not talking dividend, I'm talking profit available for shareholders, right? That's after tax margin or net margin. So the higher the margin, the better. So for every $100 of revenue that the company makes, if it is able to retain $10 as profit, that's a 10% margin. Next year, if it is able to retain $12, that's a 12% margin. Next year, if it is able to retain $15, that's a 15% margin. That's expanding margin. The more the margin is expanding, the more money the company is able to keep and maybe deploy it for future projects or maybe give it as dividends or whatever. So the margin expansion means companies either able to cut costs, bring in efficiency, or there is something that the company is doing right, maybe launched a new product which brings in more efficiency. Okay. Net margin should be at an all-time high. So let's say the margin of a company is 20%. And before that, the margin has never been 20%. That's called net margin at an all-time high. Just like annual EPS number, not the growth rate, okay? Number should be at an all-time high, the annual EPS. Similarly, net margin percentage should be at an all-time high. Read this. It's all given in William O'Neill's book. So these are the 12 criteria. This is exactly what I teach in my video course as well for to help students determine whether the stock is fundamentally strong or not. The more the criteria are in our favor, the better it is. We should look for at least 6 out of 12 to be in our favor. Even that is very risky. At least more than 50% means 7 out of 12 should at least be in our favor, right? For us to have some confidence in taking the trade. If 9 or 10 or 11, maybe 12 are in our favor, that's an opportunity you wouldn't want to miss, right? Is there a possibility that a stock meets all of these 12 criteria? You buy the stock and still the stock could come down and hit the stop loss. Of course, there is a possibility. There are no guarantees in the stock market. However, if you buy enough number of stocks which meet all of the 12 criteria, the probability of making money is more than the probability of losing money. Okay. So take note of this criteria. This is very, very crucial. You need to understand whether the company is fundamentally strong or not before even considering a positional trade in the stock. I will see you in part 7.